Hello, I'm Tony Kaye. I'm the editor of Eureka Report, and I'm joined today by Callam Pickering, our economics writer. Morning, Callam.
Good morning.
Callam, I wanted to talk today about the housing market and what's happening there. Parts of the Australian market are booming along, Sydney and Melbourne, while other parts are quite flat. So I just wanted to see what the data was showing us at the moment.
Yeah, the data certainly paints a very mixed picture at the moment. You have Sydney and Melbourne where prices are rising by 10 to 15% annually, and then you've got the other cities where Brisbane and Adelaide are rising at a fairly modest pace, and then you've got Perth where prices are actually declining and have been doing so for a number of years.
We've seen from the data coming out, in particularly housing finance, that there's a lot of investment momentum behind the activity in the market.
Yeah, over the past 3 to 6 months, there's been a really big rebound in investor activity, and that's been concentrated in Sydney and Melbourne. Investor activity was somewhat weaker throughout the latter half of 2015 into 2016, but following the Reserve Bank's decision to cut rates in February and May last year, investors have really roared back into the market, and we're seeing that with some of the price pressures that have come through.
And so there's a couple of interesting dynamics. First of all, lenders have actually been increasing some of their rates. We've seen fixed rates go up. Some investment variable rates have gone up as well. And then at the same time, the Reserve Bank is not in a hurry, it seems, to do anything with rates at this point.
Yeah, that's right. Every now and then you hear stories about how the banks have increased their mortgage rates by 10 basis points here, 15 basis points there. And over time, it really does add up such that the cash rate is currently at its lowest level in history, but mortgage rates actually aren't that low by historical standards, particularly over the past 10 to 15 years.
So from the investor's perspective, should we expect that rates are going to keep creeping up over this year from the lenders themselves, and on the central bank level, should we expect much activity there given that US rates are going to be creeping up as well?
Well, beginning with the Reserve Bank, I think market expectations right now is that the Reserve Bank won't cut rates again this year. I personally think there's probably some scope for them to maybe cut one more time, but I don't expect a great deal of movement from the Reserve Bank this year. I think they're going to be pretty happy to let the Federal Reserve do the heavy lifting with regards to policy this year. With regards to the bank lenders themselves, I think there's certainly scope for spreads to increase a little bit. We know that the banks are being forced to hold more capital against their mortgage assets, and the way they're going about that is to increase spread so that they maintain their profitability. So if you expect them to continue to increase their capital levels, which most people think is likely, then quite reasonably you would expect the banks to increase their rates as well.
They're going to have to be very careful though, aren't they, in terms of not putting undue stress on borrowers, given that many people are quite stretched, I suppose, in terms of the loans they've taken out.
Yeah, that's right. It's a fine balance. The banks are looking to protect their profitability, but mortgages are a key part of their business plan, and they can't afford to increase rates too high. Otherwise, activity in the housing market begins to decline, and suddenly that sort of threatens their profitability as well, not to mention the fact that if you do increase rates too high, then you start to look at mortgage arrears and distressed lenders, and that's never good for the banking sector either.
So on the data side, are you expecting more of the same over the near term in terms of housing finance continuing to be driven by investors, prices creeping up in Sydney and Melbourne and less so in other parts of Australia?
It's a little bit difficult to say at the moment. There's certainly a great deal of uncertainty surrounding the housing market this year. I think the mortgage side of things is very interesting because investor activity has been so strong for a number of years now, and we're talking about 3 or 4 years, that you would naturally expect that to come off a little bit. It's very hard to imagine that investor activity can remain at its current rate for another couple of years. So at some point you would expect that to come off, and when that happens you would expect house prices in Sydney and Melbourne to also cool off a little. And if, as I said earlier, bank lenders do increase their rates, then you would naturally expect that to occur. In terms of house price activity, I think there's probably some scope for prices outside Sydney and Melbourne to begin to pick up a little bit. They have been weak for a number of years now. And certainly in places such as Brisbane and Perth, we're talking about weak house price growth for between 6 and 10 years. So it's been a very long process of quite weak price growth. So I think potentially we could see investors, and certainly foreign investors, maybe move to some of these other cities where they might see more profitable opportunities.
And there's some other interesting dynamics at play which we've written about, and one is the Chinese demand. There might be some problems there in terms of people putting down deposits and then having to forfeit the deposits because they can't come up with the money. So the Chinese investment activity perhaps tapering off a bit.
Yeah, so Chinese activity has been a driving force behind the supply increase that we're currently seeing. So all those cranes that you see dotted around Melbourne and Sydney are largely a product of foreign investment coming from China. So there is some concern at the moment that perhaps demand in that segment is beginning to come back a little bit. And if that does happen, it does call into risk some of these projects that are still ongoing and could potentially hit supply and also prices in the years to come.
Oh, thanks, Callam. There's a lot of moving parts in the housing market and so much for investors to take into account. So it'll be interesting to see what happens during this year and over the medium term. Thanks for joining us.
Thank you.
I'm Tony Kaye. I'm the editor of Eureka Report. We'll see you again next time.